For those who's joining us, who did you bring with you today?
Well, we've got Bruce Helmer here, and obviously he's got the show on Sundays and with Wealth Enhancement Group, and then we've got Scott Kadrlik here with the accounting firm of MFK and Associates. And, you know, we were talking a little bit over the break here, and in your book now, Bruce, you've got actually a segment in there talking about good debt. And can you just comment a little bit about what good debt is, you know?
Yeah, thank you. And I've said this for years and years and years and years, and again, a lot of the things I'm saying today, somebody might say, well, you're saying that because you're on with the real estate guys, but I love real estate. I love it as an asset class, and it's okay to borrow money to buy real estate. If you buy, you know, it's one thing to buy stuff you don't need for the fun of it, to keep up with the Joneses, and you put it on a credit card with double-digit interest rate, and the interest is not deductible. Now how much are you really paying for that toy? That's inefficient debt or bad debt. But if you borrow money to buy real estate and you get a lower interest rate, and that interest is usually deductible, and Scott can talk to, you know, what's deductible and what's not, that's good debt. Now you're buying what is usually an appreciating asset. You're buying your home, you're buying your family's lifestyle at a low interest rate, and it's deductible. So the question we get a lot, Scott and Andy, is people will actually come and say, well, should I put my excess cash flow to try to pay down the debt faster? And I look at their situation and I go, well, you went to Cambria Mortgage and you got a 4% loan or less, and that interest is deductible, and you want to try to pay that off faster? Why would you do that? That's almost like free money.
Right.
You can put that money in an investment and probably earn a much higher rate of return, and the difference between the cost of the debt service and what you earn on the rate of return is all net gain to you. Then if someday you want to take that investment and pay off that debt early to avoid, you know, longer-term interest costs, that's fine. But the efficient way to pay off the debt sooner is not by applying it to the debt service. It's by investing it somewhere.
That's a great point.